Good morning, happy Friday. Welcome to Sunrise Small Talk, episode number 85. 85 episodes of me talking into this camera and this microphone. Pretty crazy. Today, in this episode, we are going to break down and dive into the U.S. attack on Iran. And should you be concerned? Should you not be concerned? I don't know yet. Let's look at the numbers. We're going to look at the geopolitical events over time, how they affected the stock market, things you should be aware of, or some things that maybe you can just brush off and not be too concerned about. So here we go. Let's dive in. Okay, first and foremost, broken record. I know, I get it. The best source of content, in my opinion, is going to be our website, hoffmeyerwealth.com. If you go up to the top right, you will see, let me scroll up, insights, and under insights, there's various sources there. I like to go to markets and investments. That's where this article came from. So this is a 16-minute read about the conflict in Iran, and it's got 10 things you should know or be aware of or be thinking about. I'm going to highlight a few of them that I think are the most important, starting with number 3. And I point that out because this is ever evolving, but from the time I record this video to the time you watch it, things could have rapidly changed. This article and this content comes out every Monday. So this came out on Monday. I'm speaking on Friday now. Things have changed quite a bit. But in the article, it mentions that futures were down significantly Sunday night and into Monday. And I think Tuesday was the day we had a significant drop in the market, but it rebounded by the end of the day. So my point in highlighting item number 3 here is the fact that content is changing. The status of the market and the situation in the conflict is always changing as well. A couple more that I want to highlight here. Number 6, and I realize you probably can't see that, so let me read it real quickly. Energy prices would likely be the main transmission mechanism for market risk, as they can have a meaningful impact on inflation and, through inflation, interest rates. Why is that important? As I've always said, it really doesn't matter who's in office, what the tax rates are. What matters when it comes to the market and investments is what the Fed is doing and what interest rates are doing. And that's why I highlight number 6, because that is important. What will happen with the Fed and with interest rates? So that leads me down to number 8 and number 9. So higher inflation uncertainty, which is different than higher inflation, but the unknown that higher oil prices from this attack will create and have already created, that unknown when it comes to what the Fed is going to do with interest rates is what can cause market jitters. That's important because while I'm not concerned, and I don't think you should be concerned about a major long-term dip in the market and your investment portfolio, I think you should be prepared, not concerned, but prepared for some significant market volatility while this conflict ensues. Number 8 leads me right into number 9, big perspective. This has not changed what the Carson Investment Research and Carson Investment Team, their prediction for the stock market for the year 2026 is still 12 to 15% return in equities. They had kind of priced some of this in. They had priced in some of the pullback and the tariffs and the reversal of the tariffs. This is nothing new. This is nothing they didn't know about, nothing that wasn't on their radar. And they still have a 12 to 15% expectation for the year 2026. Now, let me dive into a chart. Okay, I've said this all, and you don't care, you're still concerned because you're at the gym in the locker room and you started chatting with some guys, and these guys are super smart because they were doctors, and doctors know everything about the stock market. So you're still concerned. Let's break that down. Let's look at a piece that First Trust investment company that I've used over the years. They put out some great content. So let's look at one of the pieces they put out that pairs up and talks about the relationship between wars over time and the market. So let's jump into that. All right, here we go. These pieces, articles, the 5-minute facts versus feelings, take 5 video. We're going to link all that in the email. So whatever your preferred sources, if you want to read a long PDF and a long article, that's in the email. If you want to watch a 5-minute video, that's in the email. If you just want to look at these PDFs, that's in the email as well. So again, this is from our friends over at First Trust. wars, geopolitical shocks in the stock market. Now, I do realize you probably can't read most of this. I made it as big as I can, and we have a glare, so I'm sorry if anyone wants to donate a screen to the office. We'll accept it. So here we go. This dates back to 1928. S&P 500 index, and obviously the point is things happen and the market continues to go up. That's a long time horizon. Let's go to a couple more recent events here. Most recent on our minds is the Israel-Hamas war, October of 2023. There was no initial dip in the one-year return from October 7th, 2023 to October 7th, 2024 was 35%. So if you were the type that panicked about that initial attack and that initial news and those headlines, then you missed out on a 35% return in the S&P 500. Okay, the one before that, maybe one that hit home a little more or was seen in headlines, talked about a little bit more. Russia invades Ukraine, February 24th, 2022. I remember that moment. I was on my way up to Breckenridge for the weekend when the news came out. What happened there? Well, the one-day return was about 2%. The one-year return was actually negative on this one, minus 5%. But there was no initial dip on either of the Israel, Hamas, or Russia invading Ukraine. As we go down, this talks about Boston Marathon bombing, 9/11, Iraq's invasion of Kuwait. I think we could draw some parallels between that and what's going on right now. So let's talk about that one. That was back in 1990, August of 1990. The one-year return after that event was 13.66% in the S&P 500. Now, when we look at the initial drawdown of what's happening right now, I would almost say maybe that was a day, maybe that was non-existent because futures were down, but then everything kind of climbed back up. I think the worst day we had this week was minus 400 points or so in the Dow. So really, even that initial shock doesn't seem to be as much of a factor as it used to be with some of these other events. So anyway, I'm not going to go over this entire PDF because number one, you can't see it. And if I just read it to you, that'll be incredibly boring. But what I will highlight is this. You can see blue and you can see orange. The blue is the annualized return during specific events and wars. The orange is the annual volatility. Again, like I said earlier, expect volatility. Expect to open some of these monthly statements and see drops. Expect to log in and see drops. It's going to happen. There's going to be volatility. Volatility is a very normal thing, and the worst thing you can do is panic, sell, listen to old Dr. Tim at the gym that you ran into in the locker room that told you it's time to go to cash. Ignore all that. We got it under control. We're watching this stuff daily, weekly, monthly. It's always being monitored by Carson Investment Research and the Carson Investment Team. So with that, hope you have a great weekend. Turn off the news and get out there and enjoy the warm weather and do something fun.